Why is it that after 40 years of hard work, playing by every rule they gave you, and saving every penny you could, you still feel like you are standing on shifting sand? It is the year 2026, and for many Americans in their 60s, the dream of a peaceful retirement is starting to look more like a calculated mirage. You were told that if you put your money into a 401k or an IRA, and if you let the magic of compound interest do its work, you would be set for life.
But as you look at your accounts today, something does not add up.
The cost of groceries is nearly double what it was 5 years ago, and that nest egg you spent a lifetime building seems to be shrinking, even when the stock market is hitting new highs. There is a reason for this, and it is not because you made a mistake. It is because the system you trusted was never actually designed to make you wealthy. It was designed to turn your life savings into a steady stream of fees for the financial institutions that manage it. Today, we are going to look behind the curtain of the multi-trillion-dollar retirement industry. We are going to expose the hidden engineering that siphons off your wealth while you are sleeping. And, more importantly, we are going to talk about how you can take that power back. Before we dive into the data that the big banks do not want you to see, please take a moment to hit the like button and subscribe to the channel. Sharing this video helps us reach more people who are struggling to make sense of their financial future. And your comments below help us build a community of informed investors. Let us begin by talking about the silent killer of your retirement, the 1% fee. Most people hear that their mutual fund or their advisor charges a 1% fee and they think, that is nothing. They think, if my account grows by 8% and they take 1%, I still keep 7%, right? In a single year, that seems like a fair trade. But finance is a game played over decades, and over 30 or 40 years, that 1% fee does not just take 1% of your money. Because that 1% is taken every single year, regardless of whether the market goes up or down. It destroys the very foundation of compound interest. According to data from the Department of Labor, a 1% fee over a 35-year career can reduce your final account balance by nearly 28%. If you are paying 1.5% or 2%, which is common for many actively managed funds, you could be giving away up to half of your potential wealth to someone who is simply moving numbers on a screen. Imagine working for 40 years and then giving 20 years of your labor away for free to a bank. That is exactly what is happening to millions of Americans right now in 2026. This hidden erosion is often masked by complex terminology like expense ratios and portfolio turnover costs. The average investor does not see the dollar amount being deducted. They only see the net return, which makes the theft feel invisible. But the reality is that these institutions are taking a massive slice of the upside, while you are forced to take 100% of the downside risk. And it gets even more insidious when you look at something called 12b-1 fees. These are hidden marketing and distribution fees that mutual funds charge you, the investor, to pay for their own advertising. You are literally paying the fund company to find new customers so they can collect even more fees. It is a beautiful loop for the banks, but it is a parasitic relationship for you. Beyond these marketing fees, many 401k plans are loaded with record-keeping fees and administrative costs that are buried deep in the fine print. You might be paying for the software, the customer service, and even the office rent of the firm managing your plan without even realizing it. Now, let us talk about the concept of financial engineering and how it relates to your retirement account. In the world of high finance, there is a term called a credit-to-equity swap. Usually, this happens when a company is in trouble and they trade their debt for ownership in the business. But in a broader sense, the retirement system is a massive swap of your labor for their paper. The government and the banks want you to keep your money in the system because it provides them with the liquidity they need to fund their own operations. When you buy a target date fund, you are not just buying a basket of stocks. You are often buying a complex layer of other funds, each with its own set of fees, designed to keep your capital locked away where it can be managed. In fact, Target date funds are often referred to as a fund of funds, where each layer takes a bite out of your principal. By the time the money reaches the actual underlying stocks, it is passed through 3 or 4 different hands, all of which took a commission. This is what we call the public ledger versus the private account. The public ledger is what you see on your statement, a number that says you are a millionaire on paper. But the private accounts are where the real wealth is being generated through the movement of that capital. The banks use your deposits to issue loans, trade derivatives, and build their own empires, while paying you a fraction of a percent in return. This brings us to the great illusion of net worth, especially when it comes to your home. For decades, the American dream was built on the idea that your home is your greatest asset. In 2026, with home prices at historic levels, many of you might feel rich because your house is worth $1 million. But you cannot eat your kitchen cabinets. You cannot use the drywall to pay for your heart medication or a trip to see your grandchildren. When your wealth is tied up in home equity, it is stagnant. Worse, that equity is a target for property taxes and maintenance costs that never stop rising. In many states, the property taxes alone are becoming a second mortgage that retirees can no longer afford. The banks love it when you have a high net worth tied up in a home because it makes you a prime candidate for a home equity line of credit or a reverse mortgage. These are just more ways for the financial system to engineer a way to take a piece of your hard-earned equity in exchange for the liquidity you need to actually live. They wait until you are most vulnerable, when your income is fixed and your costs are rising, to offer you a way to tap into your own money at a high interest rate. True financial freedom is not about net worth. It is about cash flow. It is about having liquid assets that produce income every single month without you having to sell the roof over your head. Think about the difference between a golden egg and the goose that lays it. Your home is a golden egg that costs you money to protect. But a dividend-paying stock or a well-managed bond fund is the goose that actually feeds you. As we navigate the landscape of 2026, we are seeing a massive shift in how wealth is maintained. Inflation is no longer a temporary concern. It has become a structural part of our economy. The government has printed so much money to service the national debt that the purchasing power of your dollar is being systematically destroyed. This is the ultimate hidden tax. Even if you earn 10% on your investments, if the cost of living increases by 12%, you have effectively lost 2% of your wealth. The institutions understand this, which is why they are moving their own money into hard assets and commodities while encouraging you to stay in paper assets. So how do we fix this? How do we stop the bleeding and ensure that your final years are spent in comfort rather than anxiety? The first step is a radical audit of your fees. You need to open your most recent statement and look for the expense ratio. If you see numbers like 0.8% or 1.2%, you are overpaying. In 2026, there is no reason to pay more than 0.05% for a diversified index fund. Companies like Vanguard and Fidelity offer funds that track the S&P 500 for almost nothing. By switching from a high-fee managed fund to a low-cost index fund, you could effectively give yourself a 30% raise in retirement overnight. The second step is to stop listening to the noise of the 24-hour news cycle. The media is designed to keep you in a state of fear because fearful people make impulsive decisions. They sell when the market dips, and they buy when it is at the top. This is exactly what the big institutions want, because every time you trade, someone is collecting a commission. High-frequency trading firms make billions of dollars every year by betting against the emotional reactions of retail investors. The most successful investors are often the most boring ones. They pick a strategy, they minimize their costs, and they let time do the heavy lifting. Third, we need to talk about the reality of Social Security. Many of you are relying on it to be the backbone of your retirement. But in 2026, we have to be honest about its limitations. The average benefit of $1,900 a month was never meant to be a full replacement for your income. It was designed to be a floor, a safety net, to keep you out of poverty. Furthermore, the way the government calculates inflation for Social Security often lags behind the real-world cost of healthcare and energy. This means that even with cost of living adjustments, your real-world purchasing power is declining every single year. If you treat Social Security as a supplement rather than the main course, you change your entire psychological relationship with your savings. You stop asking, "How much can I take out?" and you start asking, "How much can I keep growing?" The magic of the tipping point happens when your investments start earning more in a year than you ever contributed. For some of you, that moment is already here. But you might not see it because you are too focused on the daily fluctuations. If you have $500,000 and the market grows by 10%, you just made $50,000 while sitting on your porch. That is more than many people earn in a year of full-time work. This is the power of the compound engine when it is finally working for you instead of against you. But you can only reach that point if you stop the leaks. You cannot fill a bucket that has a hole in the bottom, and the financial industry is a master at poking holes in your bucket. Take control of your prospectus. Learn the difference between an asset and a liability. An asset is something that puts money in your pocket, like a dividend-paying stock or a rental property. A liability is something that takes money out, like a high-interest car loan or a house that is too big for your needs. In 2026, we are also seeing the rise of healthcare inflation as a primary threat to retirement. The cost of long-term care insurance and Medicare premiums can easily consume half of your Social Security check if you are not prepared. This is why building a health savings account or focusing on liquid assets is more critical than ever before. As we move further into 2026, the gap between those who understand the system and those who are victims of it will only grow. I want you to be on the right side of that gap. I want you to be the one who knows exactly what you are paying and exactly where your money is going. The financial system relies on your ignorance to stay profitable. When you educate yourself, you become a threat to their business model. And that is exactly where you want to be. If you found this analysis helpful, please give this video a thumbs up. It really helps the algorithm show this content to other people who are worried about their retirement. And if you have not already, please subscribe and turn on the notifications so you do not miss our future deep dives into the global economy. I would also love to hear from you in the comments section. Have you checked your 401k fees lately? What was the most surprising thing you found on your statement? Have you noticed the gap between your on-paper wealth and your actual daily purchasing power? Sharing your experiences helps everyone in this community learn and grow together. We are entering a period where traditional financial advice is no longer enough to survive. The old rules of save 10% and buy a house are being rewritten by a system that is hungrier than ever for your capital. But by understanding the mechanics of financial engineering, you can protect what you have built and secure a future that is truly yours. Remember, the system is not going to save you. The government is not going to save you. Only your own knowledge and your own discipline can guarantee your freedom. Stop looking at the rhetoric and start following the money. Your retirement is too important to be left to the engineers on Wall Street. It belongs to you. Thank you for watching, and I will see you in the next video.